0.9. Position opened. That's a long position for euro at 118.28.9.
It's dominated by a lot of big multinational corporates, particularly in the resource space, and so it's a bit divorced from what's going on with domestic activity. Once you look at smaller and medium-sized corporates, these are the ones that are more vulnerable. So it wouldn't surprise me if a broader index, if FTSE 250, lost 5 or 10% of its value on a hard Brexit, and I don't think you really have the backstop to support the equity market the way a number of other countries have backstops for policy mistakes.
The UK certainly has been left out of what many people view as the recovery in the continent of Europe, and people are saying that is the place to invest. The narrative saying they've been recovering faster than places like the United States from the virus and have a better plan to get beyond this. Do you agree with sort of the groundswell toward European assets, or do you think it's overdone?
I think it's overdone at the broad level, meaning if you're comparing broad indices, MSCI, EMU, to the S&P, I don't think it's sufficient to say that Europe is better at managing the virus, therefore you should be overweight that index, because that index obviously has a much lower weighting to market-leading sectors like tech and communication services versus the U.S. And this is why the U.S. and Europe on a dollar basis, meaning common currency basis, have been delivering the equivalent returns over the past 4 months, even though Europe has been much better at flattening the infection curve than the U.S. So it's not just about economic momentum, it's also about sector composition. If you look, though, at sectors, maybe you could make the argument that consumer stocks should do better in Europe than in the U.S. because there are fewer risks to consumer confidence in a place like Europe, which is better at managing the virus. So if you're comparing, purely domestic sectors on a like-for-like basis, maybe Europe does deserve the nod. If you're looking at an index basis or a country basis, I still think you stick with the U.S., and that's basically because I think tech remains the leader.
I was going to ask about tech, John. What do you do with tech? I mean, we were looking at some of the valuations a couple of weeks ago, thinking, is this really deserved, talking possibly even about a bubble? And then they came out, the big stocks came out with some pretty impressive earnings.
I think that's the key here. When you think about the levels, you really have to judge them relative to the earnings momentum. And the fact is that tech is one of only a couple of sectors in the index which is delivering year-on-year earnings growth. It is for structural reasons, partly related to COVID, and structural reasons that even predated COVID. So unless you can really argue that those structural forces are going to reverse, I think it's premature to be underweighting those sectors. Maybe you could make the argument in 2021 that assuming mass vaccination, there's going to be less of demand for the kind of things that tech companies deliver. But I think of that as a temporary pause in tech outperformance. Tech was leading before COVID, and some medical solution to COVID in the next year is not going to change the long-term thesis for tech, even if it is going to change the shorter-term risk-reward around that sector.
If there's a Biden administration, John, after the election in November, what does that mean for taxes for certain sectors, and how does that change, where you want to put your money?
So I think it's going to mean higher corporate taxes on the assumption that there's a Democratic sweep, because obviously the Senate has...
Stop on profit for euro at 118.30.9. 118.30.9. Stop on profit.
So I think on kind of a 6-month basis, there's not much that's really tradable at the index level around a Biden victory and a Democratic sweep. The shorter term issues are a little more complex, depending on whether investors want to focus on just the tax issue now or focus on how that tax money is going to be redeployed into the economy. But highest conviction view is that if we get the Democratic sweep, number one, you want to be overweight infrastructure, material mining, material stocks and metals and mining stocks, because we will get some sort of bid through greater domestic infrastructure spending. And number two, you want to be overweight Asian equities and also Asian currencies, thinking that we'll have a much more sort of thoughtful and less aggressive and less impulsive foreign policy out of the Biden administration.
Thank you so much, John Norman there, JP Morgan, head of cross-asset fundamental strategy. Now let's get straight to the Bloomberg First Word News in New York City. Here's Karina Mitchell. Hi, Karina.
Francine, Democrats are showing some enthusiasm for Joe Biden's running mate. The presidential nominee says the campaign raised $26 million in the first 24 hours after he picked Senator Kamala Harris to run with him. Biden and Harris made their first joint appearance in Biden's hometown, Wilmington, Delaware. House Speaker Nancy Pelosi says she's turned back an overture from Treasury Secretary Steven Mnuchin to restart stimulus talks. Pelosi says the White House hasn't budged from its demand that the stimulus be smaller. She's offered to come down $1 trillion if Republicans raise their offer by $1 trillion, but Mnuchin accuses Pelosi of being the one who won't compromise. Meanwhile, President Trump ramped up his effort to get schools to reopen. He met at the White House with parents, educators, and researchers who argued for in-person learning. The president says it's ridiculous that some districts plan to have students attend in person some days and online on other days. And Defense Secretary Mark Esper appears to be on his way out. Bloomberg has learned that President Trump has said privately he intends to replace Esper after the election. The president is said to be frustrated by Esper on a number of issues, among them that he pushed back on the idea of deploying troops to those recent protests. One person says Esper plans to leave regardless of whether the president is reelected. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thank you so much. Now, coming up in the next hour, Wendy Schiller, Brown University Department of Political Science professor and chair, will have a good conversations about the U.S., but also international trade relations. That's at 6 a.m. in New York, 11 a.m. in London, and this is Bloomberg.
I'm moving up my stop on profit for euro at 118.33.9. Okay, stop on profit move to 118.33.9.
Nothing happened to our house, nothing broke. I just didn't realize that it would happen here in North Carolina, honestly.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
I'm Lisa Abramowitz in New York with Francine Lacroix in London. America's rush to reopen the economy before containing the coronavirus is backfiring. That's the view from Boston Fed President Eric Rosengren. He told Bloomberg's Michael McKee that extra stimulus is required.
I think there'll be an appropriate time to have forward guidance. I think at this stage of the recession and the pandemic, that forward guidance probably is only mildly helpful. And the reason for that is the long-term treasury rate is still quite low. Interest rates are quite low. And in that environment, I think people are already assuming it's going to be quite some time before interest rates rise again. So while it might be marginally helpful, I would actually say that our lending facilities and some of the facilities being run by the New York Fed are probably providing more support because they're getting at the cost of funds to individuals and businesses that I think are more important for what the outcome for the economy will be.
I want to talk about lending programs. Chairman Powell emphasizes, of course, that the Fed can lend, not spend. Is that the wrong prescription for the economy right now? Your lending programs have not seen a lot of take-up.
No, but they've been quite effective in many respects. So the announcement of our willingness to buy corporate securities quickly pushed those interest rates down. And as a result, we didn't need to buy very much because the market reacted to our announcement. So I would say credit conditions are much better than they were in March or April because of the Federal Reserve's actions. And I think that has been an important stimulus to the economy. In terms of spending, that has to come from fiscal policy. So the U.S. economy also benefited from the kind of very quick and very significant stimulus provided by both providing better unemployment benefits, broader unemployment benefits, checks to low-income individuals. All those things have been very helpful in preventing particularly low-income individuals from being able to continue to make spending decisions over the course of the spring and into the summer. But I think many of those programs have ended as of the end of July. The pandemic has not ended. The unemployment rate is still above 10%. So we need stimulative fiscal policy to continue. I think that's critically important that Congress come up with some kind of agreement to continue to provide support.
Have you modeled the impact from the end of that fiscal stimulus?
My personal assumption in my forecast is that some form of additional stimulus is going to occur. It would definitely be bad news both for my forecast and for the economy if we don't do any additional stimulus at this time.
You supervise the Main Street program. That's perhaps the most controversial. According to your figures, $856 million in loans in the system, but it's a program that could do $600 billion in loans. Does that suggest modifications need to be made to the Main Street program?
Well, I'd highlight we've already made quite a few modifications. So we had an initial term sheet. We came out with a revised term sheet, and then it was revised once again to make the program broader and more accessible to a wider range of small businesses. We've also opened it up to the nonprofit sector. While we're not live on that part, banks are perfectly able to start the negotiations with the nonprofits. As you know, it takes a long time to actually negotiate a bank loan. So it doesn't surprise me that we would start gradual and that it would pick up over time. And so I think that's exactly what we're seeing. One reason we're seeing a lot of the lending coming primarily from community banks and mid-sized banks is they're probably a little bit more flexible and are able to adapt more quickly. I would expect that larger banks over time will start using the facility more. And the goal is to make sure that businesses that actually need it, that are creditworthy in February, that have had their cash flow disrupted, and are likely to be viable businesses after the pandemic is over, are able to get that kind of cash flow financing. And I think we are seeing a pickup in that activity. I expect as borrowers and as banks get more familiar with the program, we'll continue to see increases.
Well, that was the Boston Fed President Eric Rosengren. Now, coming up next, Sarah House, Wells Fargo Securities senior economist. Just a couple of things to talk about in the markets. So we're looking forward to that interview. That's coming up shortly. And this is Bloomberg.
isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg Business Flash. Two of JCPenney's biggest landlords reportedly may buy the chain's retail business out of bankruptcy. According to Dow Jones, Simon Property Group and Brookfield Property Partners have teamed up and are in advanced talks. The two are seen as the leading contenders. Dow Jones says they've offered concessions over lease agreements for Penny's stores. Meanwhile, Lyft posted its worst financial performance as a public company. The ride-sharing business reported a 61% decline in revenue, and Lyft's loss rose by 37%. Still, both numbers were better than expected. The company maintained its forecast for a quarterly adjusted profit by the end of this year. And Apple has a $44 billion market in China. It's now threatened by President Trump's executive order that prevents U.S. businesses from doing business with WeChat. That's the app that has become integral to everyday life in China. One Hong Kong resident says the WeChat ban threatens to turn iPhones into expensive electronic chat. That ban takes effect in roughly 5 weeks. And that is the Bloomberg Business Flash. Fran, Lisa.
Karine, thank you so much. Economists at Wells Fargo Securities say global growth is looking mildly more positive. They point to momentum in Europe, China, and Canada, but not all economies are on the upswing. Well, joining us now is Sarah House, Wells Fargo Securities senior economist. Sarah, great to have you today. Now, I like the way you put the U.S. overview, which is a riddle wrapped in a mystery inside an enigma. What are you expecting from job numbers?
Well, I think in terms of the continuing claim numbers that we'll get today, I think we'll see another tick down. So when we look at the week that this covers, so this is the continuing claims cover the week ending August 1st. The new jobless claims are the first week of August. And we did see new coronavirus cases begin to fall over that period, positivity rates flatten out. And so there's hints that the virus situation is at least looking a little bit more stable. And we think that the jobs market is going to follow that closely. And so we are expecting to see some further improvement in terms of the jobs situation, but the pace of that improvement is going to be much more mild than what we've been seeing over the past couple months.
Sarah, when do we know if some of these lost, or these jobs that have been lost are actually permanent? How long does it take for that to really take hold?
Well, I think it still could take some months to come. We're still in the initial phase of the bounce back, and so we've seen some really strong numbers out of the industries that have been hardest hit, like leisure and hospitality. But I think that's the big risk for the jobs recovery going forward, is that really the longer the crisis continues, is do you start to see some of the jobs weakness spread over into other industries that maybe weren't initially hit. So perhaps some of the more white-collar industries, as we're seeing pressure on companies' bottom line, so that's going to impact jobs at the corporate level, even those that can safely work from home, as just companies are trying to better control their labor costs. And so I think that's really what we're going to need to be watching in the months ahead, is that composition of job growth, where you're seeing some of the strongest increases, or alternatively where you're seeing job growth actually stall in certain industries.
In the meantime, we're seeing gridlock in Washington, D.C. They aren't getting together to come to any sort of deal for another round of fiscal support. Are we looking at a policy error here?
So I think we're certainly at risk of...
We close position on euro at 118.33.9. Profit £500.
Needle much when you compare it to what Congress can do. So we think that there's still a good chance that you get some sort of deal, but right now there's really not that crisis moment that I think Congress is trying to stave off. I think they're getting some conflicting signals in terms of how desperately the economy needs some additional stimulus when you look at where markets are, and even the fact that you are seeing the job market continue to improve. So while we're still 13 million jobs short of where we were in February, we did did see almost 2 million jobs added last month, and so I think that's taken some of the fire out of Congress to maybe get a deal done very soon. We think that maybe it gets wrapped up in the budget negotiations that we'll need to see done by the end of September. So we still don't have a budget for fiscal year 2021, and so that might give an opening for some negotiations.
Well, Sarah, let's say that they don't come to a deal by September 1st. How much does this negatively impact your expectations for U.S. growth?
Well, I think it really puts consumers in jeopardy. So we saw consumer spending what really led the downturn in the second quarter, but we're also looking for it to lead the bounce back.